So this is in regards to day trading. Ronnie Coleman, who's one of the greatest bodybuilders in history, has a famous quote. It says, "Everyone wants to be a bodybuilder, but nobody want to lift no heavy ass weight." What he means is they want to look good, they don't want to put in the work. The same thing goes with day trading. A lot of people want to be good at it, but they don't want to put in the work. They don't want to study. They don't want to perfect their skill. They just want to throw money at a stock or option and just hope it works their way and they make money and it goes that way every day or whenever they're trading to constantly make money. They have no system. They have no discipline. They have no risk management. They have no risk tolerance. And this is why so many people fail at this. You are competing against machines, algorithms, some of the smartest people on God's green earth, people with huge amounts of money, millions, billions of dollars. And there's just trillions of dollars moving in the market every day. So your number one goal is to not get run the fuck over. That's number one. Number two is you need to pick your shots. The best way to make money, in my opinion, because I've been doing this for 8 years and I tried every type of strategy you could think of, is number one, pick one or two things that you're good at trading. Me, it's SPY and it's QQQ, and I've perfected this to one DTA option. So options I buy today that expire tomorrow. They move good. There's not as much pressure as the 0 DTE, which is a lot of pressure because you basically have to be right almost immediately or it doesn't end well for you on that particular trade. But also having the ability to average into positions. You know, a lot of people, they just want to keep averaging down into a position. Now, me personally, I suck at averaging into a winning position. So, for example, if I make a trade and I bought 10 SPY calls, right? And just say the stock price just instantly goes up. I'm probably trimming 5 very quickly, and then I'll start trimming the other 5 in staggering formation, basically. If it continues to go my way, I'll probably trim 2 more, and then I'll raise my stop loss on the last 3 to break even or just above break even, and then adjust accordingly. Now, I also, before I even get into a trade, I will tell myself I am allowed to buy X amount of contracts on this particular trade. And the further away from VWAP it is, the more contracts I'm willing to take for a reversion. So if you're very, very far below VWAP and I'm looking for a bullish reversal, I'm going to start buying more and more calls the further away from VWAP it goes, assuming that we're starting to show some type of uptrending motion. I don't want to catch a falling knife because that's how your hands get bloody. And vice versa, just say I'm bearish and I want to buy put options for a reversion towards VWAP. I'm going to start buying the higher above that pump is. I'm looking for buyer exhaustion or a resistance level. And that's where I'm starting to buy the put options. And like I said, if I bought 10 and it goes my way immediately, I'm probably just going to take the profits and not think about it and wait for another opportunity. What you don't want to do is you get a winning trade, it goes your way, you're all out of the trade, and it keeps going the way you wanted it to, and now you FOMO into the position, and then because out of greed you're like, damn it, I sold too soon or I took profit too soon. Now you're just putting yourself in a terrible situation because now you can have a reversal. Now, one thing that I still admittedly need to get better at is when we have bearish days, and I have the right thesis early in the day to buy put options, to short the pops. And it's working well. And then eventually you reach a bottom. And now you start getting bounces. Now, I could do a better job of getting into calls when it's going that way. But oftentimes I will still short the pops, but like smaller size, and if it keeps pumping, I will keep averaging into those puts. And It usually works because I have enough averages into the position, but this is dangerous because if you get one of those days where you get a V or like a really explosive pump back up, you would have made so much. One, you make more money on calls. The other way is that you're just fighting it. Like, you don't want to fight the reversals. Fighting reversals is one of the best ways to lose money in the market. Now, a lot of people, especially when they start out, and I was the same way, you start out with the smaller cap stocks, the hot stocks of the day, which are almost inevitably pump and dumps. Usually a terrible idea. Now, I will say that in pre-market, those stocks usually have their best moves. But the problem is you can't use a stop loss in pre-market, so you have to be ultra disciplined and size accordingly to those type of things. Now, I'm not immune to this. If there's a hot stock going off and I feel like I have a good opportunity of making money, my job as a trader is to make money. That's what I'm here for. I don't want to sit there working at a real job until I'm 65 to get Social Security for a few years and maybe your life expectancy is 75 or whatever it is. That's not my goal. My goal is to keep making money trading so that work is optional for my existence. And that's something that you have to define when you want to be a trader, when you're getting into trader. Am I doing this part-time as a side thing, or is this my goal to be a full-time trader? If it's your goal, you can make life-changing money, but you have to have the highest level of discipline and risk management. So I know a lot of guys, a lot of traders, they just trade Apple. They trade either shares on Apple or they trade options on Apple. Not a terrible decision. You're probably getting a good $4 to $5 true range per day on Apple. Good stock. Nvidia, another one, usually $4 or $5 true range. It's pretty good opportunities. Palantir, nice range on that one. You want so a lot of guys do Tesla, but it really depends on what you know best and what your levels are. Now, I always, before the market opens, use stockconsultant.com. It's free. There's a pay service, but it's free. And you can look up, I think, up to like 7 or 10 tickers per day. And you can see their support levels and their resistance levels. And nothing's perfect, but I will say they're pretty freaking good. And it has helped me a lot by like comparing their levels to my levels. Now, a lot of people will debate you should use a 1-minute chart, a 5-minute chart, a 10-minute chart, a 15-minute chart, a 1 hour, a 4 hour, whatever. Now, my particular strategy is I have 2 screens. I use a 15-minute chart on SPY or QQQ, whatever one I'm trading, whatever one's giving me better levels on that particular day or time of day. That's on my computer. And then on my phone, I also have Webull up, and I use a 1-minute chart. And that helps me, the 15 gives me the more clear support and resistance levels. The 1 minute helps me see more of the price action in current form. Now, you never want to YOLO into a trade. You never want to risk too much of your account, and you never want to buy all your calls or all your puts or all your shares or all your shorts at one particular time, because that means you have to be absolutely perfectly right the second you get into the trade. That is a horrible idea. So you need to define your risk per trade, whether that's 3 contracts and options or 300 contracts and options, or 100 shares and shares, or 300 shares of shares, whatever it is. But make sure you're defining your risk before you enter the trade. It's going to help you stay calmer. You're not going to panic if the trade goes away, gets you instantly. And I will tell you, one of the worst things you can do, and nothing is foolproof or idiot proof, but just say you're bearish on the day and the trend has been lower highs and lower lows, and now you get stuck in a put trade or a short and it's not going your way, and you just you tap out. You're like, I'm wrong, okay. And then you instantly want to flip in the opposite direction into calls or a long because you think, oh right, I'm totally wrong, it's bullish. Now, there's going to be times where that works, and it's a good idea. But there's also times where that's going to be a terrible idea, and you're going to lose more money. So you're like oppositely doubling down on your own stupidity. Don't do that. If you've been doing this a long time, you're probably going to get a good sense if the market is bullish or bearish on that particular day. No one's 100%. You're lucky if you're right 70, 75% of the time. But if you let the pattern develop in the first 30 minutes to an hour of the day, you tend to get a good sense of if the market's going to be bullish or bearish on that particular day. Now, of course, there's events like Fed days where you have the Fed decision at 2 p.m. And then there's days where the president will speak or some news drops or something like that. And then in earnings seasons, things can change when big stocks are reporting earnings after hours. But you need to just, be cognizant of this. Now, me particularly, I make 90% of the money I make trading before 11 a.m. That's usually goes. The first few minutes, I might take an exploratory trade where I might take 5 or 10 contracts on SPY or QQQ, but I'm not hitting 100 freaking contracts in the first few minutes. And I'm certainly not hitting 500 contracts in the first few minutes because it's just too crazy. The price action, there's just too much risk one way or the other. If you're right, you could be really right, but when you're wrong, you could be really wrong. And let's be honest, people are quicker to take profits than they are to take a loss. It's just human nature. And that's something you want to avoid. Now, I'm not Superman. I am not wanting to take a loss ever. But I know sometimes if it's a small position and I know I'm just dead wrong, yeah, I'll get out unscathed. You take the small loss. But if you're averaging into the position, you really need to know that the odds are in your favor. Now, here's something with VWAP that I'm sure no one wants you to know. Almost every day, SPY or QQQ are going to touch VWAP at some point in time. It's not 100% guaranteed, but there's going to be times where it drops under VWAP and it's going to make a run back towards VWAP. And there's times where the day is so bullish that it seems like it's going to go up and to the right all day long. But usually within the first hour of the day, it's going to make a retracement back towards VWAP. Now, if it's a really bullish day, it might hit VWAP or come right above VWAP and instantly bounce. When the market's super bullish, I want to be buying around VWAP for those particular moves back up. Now, when the market's super bearish, I'm looking to get into puts at VWAP for a rejection. Now, say I'm wrong. Say I'm bearish at VWAP and the market blasts through VWAP. I'm not going to instantly add to my put positions while it's still above VWAP. What I'm waiting for is the market to stop going up. Maybe it takes 50 cents above VWAP. Maybe it takes $1 above VWAP. Then you want to add to the position for a retracement back toward VWAP. And then it could go back up and to the right if it's going to be bullish. But you want to stack the odds in your favor. And a lot of people, this is a problem that a lot of traders have. When you're trading options, a lot of the people are looking for these home runs. They look at these Wall Street bets trades. They look at, screenshots on social media. I can tell you the average contracts I'm buying, I usually buy slightly in the money. And if it's 1DT, they're ranging from $300 to $400 a contract. And my average trades are probably 50 to 100 contracts per trade. I'm looking for 0.05 moves in my direction. So if I have 100 contracts, I'm looking to make $500 minus the commission on that one particular trade. I'm not looking for 50 point move on that where I'm looking to make 5,000 on one trade. Now, sometimes that happens, I get lucky. It goes really my way and I can adjust the trade accordingly. But I am the type of trader who's going to make 20 trades a day, 25 trades a day. So if I have a small loss of $500 on a trade,